Good evening, everyone. Welcome to our Sacramento Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks for taking some time out of your busy schedules to join us on this Wednesday evening. Hope you all are having a great week. We're going to present to you our Sacramento Homebuyer Workshop in partnership with Sac State. You may have heard a little bit about this workshop through the Sac State alumni and athletics, possibly just from our presence here in the Sacramento area. We are a local Sacramento lender, so it's really fun for me to get a chance to teach this workshop locally today. We actually present this same type of workshop all across the country through different university partnerships. So the fact that we're broadcasting this from downtown Sacramento today is pretty exciting for us. We've been teaching classes like this for over 10 years, and we're really proud of all of our different partnerships across the country, especially our partnership with Sac State alumni in athletics. Tonight's class is going to be very interactive. We encourage questions as we go through tonight's content. So we'll be weaving in questions and answers as we talk through tonight's content. We'll also carve out some time later on in tonight's discussion to answer any questions that you may have from our audience. Just a little bit about me. Again, my name is Jason, and I'll be your presenter this evening. I work with an organization called American Pacific Mortgage. We're a Sacramento-based lender, but we're a nationwide lender. So right from our offices here in Sacramento, we support home ownership across our communities across the country. We teach classes like this to help inform our community and educate on what buying opportunities can look like for home buyers. And so we teach classes like this throughout the year. We'll teach over 55 classes this year. And so this is one of those 55 classes specific to the Sacramento market. We have a large sign-up attendance, or sign-up, I should say, list for tonight's class. So we're going to allow everybody to kind of get into the session. But this is, again, very interactive. We're also going to record tonight's class. So this class will be up on our YouTube channel tomorrow. In fact, all of the content that I share with you this evening is going to be shared back out with you via email. So we'll go ahead and share all the slideshow. And of course, like I said, we're going to record tonight's session. So like I said, we're going to have a pretty good sized class. And so we're looking forward to a really energetic and fun class tonight. Well, here's kind of what we're going to talk a little bit about tonight. We're going to spend some time looking at the housing market, both from like what's going on in the local housing market and also what's happening from an interest rate perspective. So we'll kind of dive into that locally here and see what that looks like. And then we're going to talk a little bit about a rent versus buying situation, like basically a budgeting calculator for home ownership. Does really buying make sense for me? So I'll walk you through a calculation tonight, but we're also going to talk a little bit about the benefits of owning a home. We'll transition from there into credit. How do we maintain and maybe improve upon our credit to prepare ourselves for home buying? We'll also talk a little bit about loan programs and what different tools and resources are available to me on my path towards home ownership. And then we'll talk about savings plans. You know, saving up for home ownership can be one of the challenges for most prospective buyers. So we're going to talk about a savings plan towards home ownership. We'll also then kind of look at first-time home buyer programs that are available all across California. And then we'll look at the buying process. So after tonight's class, you may say, hey, Jason, I want to learn a little bit more about home buying and how to design my own home buying plan. We're going to kind of coach you through that and then show you how those steps look like on your pursuit or in your pursuit of home ownership. And then finally, from there, we're going to talk about kind of setting up a consultation with us to be able to design your home buying plan. I appreciate everybody getting all of your questions in the chat. A couple things that came up. Questions that you have, just go ahead and type those in the chat, or you can use the Q&A, and then, of course, we'll answer those questions accordingly. And then, yes, we are going to record tonight's class. It will be up on our YouTube channel. All of those links will be available. Ken is actually kind of commenting in chat right now for you guys. Ken is actually going to help me with some of our questions because we have a pretty good-sized audience for tonight's class. So we want to make sure we're timely with all of your answers and get a chance for the whole group to participate in some of that Q&A. All right, well, let's talk a little bit about buying. Does it make sense for me? Just keep in mind, purchasing a home is probably going to be one of the biggest financial decisions you decide to make. So the fact that you guys are taking time out of your busy schedules on a Wednesday night at 6 o'clock to learn about finances and home ownership tells me, obviously, how serious you're taking this next steps in your financial future. So it's a big deal, right? And when we consider home ownership, we got to consider some of the benefits that come along with owning a home, because it's really not like renting a house. With renting, of course, we're paying that rent on a monthly basis, really not realizing any benefits of that other than just having housing, right? But when homeownership, we take a look at that a little closer, it's a lot different, right? So you can create stability in homeownership versus waiting for the landlord to potentially increase your rent or possibly sell the home that you're renting right now. All those things can create a little bit of instability for yourself when it comes to housing. Even in this elevated interest rate environment, which we're going to talk about in just a bit, clients can still purchase at this level of interest rate in today's market, but they can always look to refinance in the future. And we're going to talk more about that later on tonight, because most of our clients that are purchasing today may have slightly higher interest rates in the market just because of where today's interest rate levels are, but they can look to refinance in the future. This is an asset, probably going to be one of the biggest assets that you have available to you. And it's an opportunity to grow in equity over time. Well, what is home equity? Home equity is looking at the value of your home versus what you owe on your house. And that equity is one of your largest assets that you possess. And as that asset continues to grow over time, you have the ability to be able to pass along that asset to heirs of your estate, for example. And believe it or not, there's some really good tax benefits that can come along with owning a home, potential tax deductibility of interest, and the ability to potentially deduct interest or energy efficient upgrades to your home as well. So when we think about homeownership, we got to put all of those fantastic benefits into the calculation, because truly comparing renting versus buying is not really an apples to apples comparison. And to kind of illustrate that point, what I thought we would do is kind of talk through a little bit of a budgeting calculator. And so we're going to go and do a side-by-side rent versus buying calculation. And for tonight's class, I'm going to kind of switch into our browser here so we can kind of look at that calculator. With us sending out the presentation tomorrow, you're going to be able to access this link. This is a calculator brought to us by Freddie Mac. You're going to learn a little bit more about Freddie Mac and Fannie Mae a little bit later in tonight's class. But ultimately, they provide funding resources for lending. And so this calculator can kind of frame up for us a side-by-side comparison of renting versus buying. So let's kind of dive into this. And I have it up on screen here, and we'll kind of open up these tabs. You can see we're going to first talk about renting. We're going to just kind of pre-fill in $2,500 as a monthly rent amount. We assume monthly renter's insurance at $15 a month. We have anticipated rental increases of 3% on an annual basis. And then we're going to take a look at the home purchase tab. So for our scenario here, we're going to assume a client is going to be spending $450,000 for their mortgage. We're going to talk about down payments in just a little bit later in class, but we're going to learn in class that the minimum down payment to purchase as a conventional loan is 3%. So we'll plug that in as our down payment amount. And then we factor in property taxes for my $450,000 home, homeowners insurance estimates, which can vary based upon location of where I'm going to purchase. And then we also factor in maintenance costs of my home. Okay, so that goes in the home purchase section of our calculation. And then we also have loan information. Now, what is our loan going to look like? What's the term of my loan? Well, in this scenario, we have 30-year fixed as the mortgage term. We have an average interest rate of 6.875%, which is kind of the average rate today for a 30-year fixed mortgage product. And then we have origination charges. That's what a lender will charge you for your financing. Now, one of our benefits that we provide to our Sac State alumni in athletics, as well as to local state employees, is a discount of our origination cost by $750 in partnership with those affiliations. And so that will help lower your lending cost to hopefully more affordable levels for you. But as it goes for lending, there will always be what we call closing costs, but part of those closing costs will include lending items. And of course, like I said, we have a discounted option for you there. Discount points are where you as a buyer decide to pay additional expenses out of pocket in order to bring down that interest rate, because maybe you're trying to achieve a certain payment level or whatnot. Usually one discount point is the equivalent of 1% of my loan amount. And usually that one discount point will lower my interest rate about 0.25%. Now, in today's market where we're essentially at elevated levels, most of our clients, as I mentioned earlier, where we were launching into class, are probably going to consider refinancing in the next couple of years. The break-even point on discount points is about 3 to 4 years right now. So we don't necessarily recommend those investments right now because it's really difficult for our buyers to get a good break-even point on those type of investments. As we kind of move down further, we have other settlement services. Those are going to be things like title, escrow fees, maybe some of the government charges for transfer taxes, recording costs. When we think about lender costs, title, escrow fees, government charges, those fall under the category of closing costs. So when we think about savings for a home, we want to look at saving for our down payment, which we're going to talk more about minimum down payments later, but we also want to save for closing costs and prepaid items. We generally recommend clients budget 2 to 3% of their purchase price for those expenses. And then finally, within this calculator, we want to look at other assumptions. And those other assumptions for this calculation, we're going to assume that our home will appreciate 4% on an annual basis. We're going to side-by-side compare 7 years as a renter versus 7 years as a home buyer or homeowner. We have selling costs of our home. So at the end of the 7 years, what's it going to cost to sell that house? And then we have state and federal tax rates as well as the savings rate. So ultimately, when we kind of take a look at what this looks like from a kind of payment comparison, if you will, you can see from a rental perspective, we know we're at $2,500 a month, assuming the rents go up about a 3% on an annual basis. If we compare that to owning, we are going to have to expect an increase in housing budget if we're going to own at that price level, because now our housing budget goes up to like $3,800 a month. However, if we stack side by side renting versus owning, there's about an $87,000 buying opportunity versus renting over the 7 years. And the reason we get there, or how we get there, I should say, is when we look at appreciation of my home over the next 7 years, but we also take into consideration potential tax deductibility benefits that also come along with owning a home. So clearly, buying can make sense for that particular scenario, but it's really important for us to kind of design a home buying plan that makes sense for someone. And because not everyone is in the position to be able to take on maybe a higher expense of $3,800 a month as opposed to $2,500. So we really want to kind of figure out what the right calibration is, if you will, for what homeownership looks like for someone. And I really think that calculator is a great way to start kind of figuring out what homeownership might look like for you. All right. Okay, so let's kind of talk a little bit about the housing market. And, most of us, I think, are locally in the Sacramento market. There's a lot of trends in the Sacramento market that look very similar across the country. And right now we're kind of in like the winter months. Today's a nice day here in the Sacramento market, but we've had some rain as of late, right? A little bit colder than what we see in the spring and summer months and maybe the early fall. But ultimately, housing markets will have seasonality. So usually as weather starts to improve, buyer activity picks up, more sellers are apt to put their homes on the market. This 2025 market looks a little bit different, though. We're seeing buyer activities at elevated levels this year, much earlier than we typically see. Our kind of rule of thumb, which is somewhat funny, is that after the Super Bowl weekend is usually when we see buyer activity levels pick up. But we've actually seen it just right out of the gates in 2025, buyer activity levels picking up. We haven't quite got a pulse on or a really good understanding of why that is. I think some of it could be concerns of, is this housing market going to continue to grow and I'm going to be left on the sidelines? Maybe concerns about changes in administration, concerns about interest rates. There's a kind of a variety of different reasons, but ultimately at the end of the day, buyer activity levels have picked up. Now, we're still struggling with the inventory levels or supply that's available to buyers. And so we're kind of in a little bit of a struggle here where some buyers may not have the availability to get into resale homes and maybe they decide to move over to more new construction. But you can see a little bit of the market activity, especially most recently, you've seen a little slight uptick in price, maybe even almost level. We'll have to see how that chart kind of plays out over the next 3 to 6, maybe even 12 months, because as buyer demand continues to grow, if there's not as much inventory to support those buyer demands, we could see prices rise. And, Sacramento's a bit of a unique market from the perspective that there is still a lot of Bay Area migration coming to the Sacramento market, which is good for sellers, not necessarily good for buyers. But at the same time, that will have an influence in today's market. So this kind of chart, which you're seeing on screen, is a 3-year snapshot of the housing market here. This little dip right here was really kind of like more of an interest rate driven market, a little bit of seasonality, but you can see a little bit of a neutral to maybe slightly uptick in the housing market. Now, interest rates are going to play a major role in what happens now in the housing market and on a go-forward basis. We still are at elevated levels, which I commented on earlier in class. Average rate is right around the 6.87 level, in maybe just hovering around 7%. I don't think we're going to see any significant changes this year in interest rates, is kind of how we're looking at it. We may creep down to 6.5%, but I think we're going to still remain at those elevated levels, at least for the next 6 to 12 months. And then as we move into 2026, we might see interest rate levels come down a little bit. Now, I think it's important to take a snapshot of what does it look like in the last 20 years, because, coming out of the pandemic interest rate levels where rates are at 2.5%, and now we're up at the 6.8 level. Obviously, there's an incredible sticker shock for many buyers that are just exploring the markets today. But I think if we look at historical averages, especially if we go back to early 2000s, like we're not too far off of that. Average interest rate historically is right around the 5.25% to 5.5% range. I think certainly the pandemic interest rate levels are not a good measurement of what interest rates typically are, because obviously that is, was an incredibly challenging time for us globally. And, we don't want to obviously go back to anything like that. And certainly anything catastrophic like that is going to have a massive impact on the financial markets, which it clearly did. Now, coming out of that, we're currently in an high inflationary market. And so, you guys have obviously feeling the pressure of inflation today with the cost of goods, fuel, our day-to-day lives are more expensive. Housing's more expensive, of course. And so, why we're at these interest rate levels, I think is important to understand. The Federal Reserve has been trying to combat inflation by elevating the federal funds rate. And with the anticipation or goal to get inflation to 2%. We're still at elevated levels of inflation, but we are seeing the Federal Reserve back off of interest rates a little bit. We don't think they're going to cut rates next month at their next meeting, but there will be probably 3 to 4 potential cuts this year, but it remains to be seen. The goal, again, is 2% inflation, and then we're looking at what the labor markets are doing. Labor markets still seem somewhat strong, and so, the way interest rates work is generally when we see bad news in the markets, that usually helps improve interest rates. So job markets are still pretty strong. Inflation is still a little bit high. So we're kind of just getting a gauge if the Federal Reserve are going to cut rates over the next 2 to 3 months. But we don't think we'll see anything next month in the month of March. But I think the takeaway from understanding interest rates, especially in today's market, is we'll probably still remain at these interest rate levels that we see today. But from a buying perspective, if we can still enter the market, I still think it presents an opportunity for buyers today. Because ultimately, if I can still get into this market at affordable levels for my budget, hopefully in the next 2 years, maybe 3 years, I have an opportunity to refinance my home where I'm essentially now moving my existing loan into a lower rate product to help create better payment levels or ultimately savings for my mortgage. And that's what the kind of more strategy is being used by most of our buyers in today's market is like, hey, I'd love to get in the market if I can. And then ultimately down the road, I'm going to hopefully consider refinancing when rates start to more normalize. Well, interest rates aren't the same for all buyers, and I think that's important to understand that. There's a variety of characteristics that go into interest rates, like credit scores and eligibility, what type of loan program I'm going to select, what my amount finance looks like, how much is my down payment going to be? Did I decide to bring down my interest rate with discount points? That can have an influence on my interest rate. Again, to go back to my commentary earlier, it's like I don't necessarily recommend paying discount points in today's market, but certainly an option to help bring down your interest rate. And then if we also shorten the term of my loan, so let's say a standard 30-year loan's at 6.8 today, I may be able to get a slightly lower interest rate by condensing that term into maybe a 20-year or 15-year product. It's our job to help kind of design the right program for you. So as I get a chance to meet with clients all across the market, we're going to figure out the right design of your financing, whether that's a first-time buyer program or some of our standard programs to fit your household budget, to make sure that we can create an affordable and most importantly, a sustainable home buying plan for you over time. Right? Now, credit is one of the biggest factors into home buying that we have to kind of dive into. As I kind of look at designing home buying plans for clients, there's usually kind of 2 challenges to home ownership. It could be around savings because I just haven't got enough to build up my savings nest egg, so to speak. Or maybe I'm overextended with debt, or maybe I've had some past credit challenges. There's a variety of different reasons, but usually those are kind of two of the bigger challenges for most clients. So in our classes, we like to dive into credit, explore some different options and just understanding, if you will, around credit. So I think it's important to understand that every product is going to have a minimum credit score. So you can see those on screen. FHA loans are 580 minimum credit score, conventional 620. Our VA Veterans Home Loan has a 620 credit score. And some of the first-time buyer programs that we'll explore tonight have minimum credit scores of 640. Okay, so now when we think about interest rates, we think about mortgage insurance, all these different factors that go into the mortgage offering, credit score is going to play a role in those particular areas. Now, major credit events that we've had in the past, let's say a bankruptcy or a short sale, maybe a foreclosure, those are going to have bigger impacts to my credit score as opposed to maybe a late payment that was 2 or 3 years ago. At the same time, any event that happens on my credit report in the most recent 12 to 24 months is going to have an impact to my credit score in some way, shape, or form. Now, we're going to talk about credit utilization a little bit later on when we go through kind of the weighting of credit score. But when we think about credit utilization, we're looking at our outstanding credit balances versus our credit limits that we have available. The lower my credit balances are in relation to that credit limit, the better my credit utilization is. And account closure is essentially when I'm taking one of my revolving debts, like a credit card, and I'm closing out the account. We want to be cautious with that because one of the measurements that credit scores look at is how long have I had credit? Well, when I decide to close out a credit account, that actually pulls out all that great history and really the history, but also the payment history of that account. So we really want to be careful because maturity of accounts is a big part of the credit score model. Now, when we look at credit scoring in lending, we look at all three agency scores, and you guys probably know these agencies. It's TransUnion, Experian, and Equifax, right? Now, we look at the middle score of all three agency scores. So, for example, if my highest score is 760, let's say my middle score is 740, and then my lowest score is 720, we're going to take the 740 from a qualifying perspective. Now, if I'm going to apply with my partner, but let's say my partner scores are slightly lower, maybe they're 720, 700, and 680. Well, from a financing perspective, I have to take the lowest credit score between the two of us, which in this scenario would be the 700 score. So as we get a chance to meet with clients and design their home buying plan, we're going to talk through kind of optimization of the financing because, it may make sense for maybe to have financing in one individual's name as opposed to combining because, just it makes more sense financially for a client. But those are things that we can talk through as part of a consultation. Well, as we dive into credit reports, there may be some things that pop up that we need explanation on or concerns that we want to bring to your attention. When we think about negative items on a credit report, this is just a quick little matrix that's going to give you some guidance as to how long these items will stay with your credit. To my point earlier, though, the impact that you're going to see on your credit score is in the most recent 12 to 24 months, right? Let's dive into the FICO score calculation. There's actually 3 different models to FICO scoring. One is there's a credit card model. 2 is there's auto financing. And then the third, which is most relevant to what we're discussing, is the mortgage model. And when you're looking at your monitoring services, like maybe you guys subscribe to Credit Karma or some of the agency models, they're using the credit card risk model. And so you may see some variance between what your score shows up on Credit Karma versus what we see at APM when we decide to pull your credit report during your qualifying. So just something to keep in mind. There's going to be just different risk factors in a mortgage score that's looked at differently than, say, what we see in the credit card model. So here's what the score calculation weighting looks like. So we talked briefly about it earlier, which is the length of credit. So, the longer my credit profile is, the more outstanding credit I've had for a longer period of time, potentially the better my credit score is. Now, at the same time, as we move further into the model, we want to be careful that we don't try to access too much new credit because as we open new accounts, we want to limit that because ultimately the more accounts I try to open, the impact it could have negatively to my credit score, especially as it relates to inquiries on my credit. So when we think about credit inquiries, there's 2 versions of inquiries. One is there's a hard inquiry, which ultimately with a hard inquiry is going to have an impact to your credit score. And we really want to be limiting those hard inquiries, especially in the most recent 6 to 12 months. We want to not make sure that we're going out and actively applying for multiple lines of credit. Now, there's also soft inquiries, and that's how we start our process here at APM, which is ultimately access to getting visibility to your credit file, but not impacting your credit score. In fact, we can actually pre-approve you just off of a soft credit score. The next component of the FICO score weighting is utilization. I've kind of commented on that earlier, but ultimately we're looking at revolving accounts, and utilization is measuring those balances to the credit limits as a percentage. So for example, if I have $5,000 in credit balances and I have $10,000 in credit limits, I'm right now at 50% utilization. Now, maybe I just booked a trip to Disneyland and I'm at $8,000 in balances. So now I'm at 80% utilization. So my coaching for a client in that scenario would be, let's work from 80% down to 50% utilization so we can get a little more comfortable and see an improvement in our credit score. And then the goal is to now whittle that credit balances down to 30% and optimally try to get to 10% utilization. That'll give us the best possible score results. Now, let me give you a quick tip on how to manage credit utilization. So as maybe a homework assignment, if you will, take a look at one of your credit card statements at some point. There's going to be a billing cycle or statement date. There's also going to be a due date. And so the billing cycle or statement date is the time at which the credit card issuer is going to send out all your reporting information out to the credit report agencies. And so they'll report your payment history, your credit limit, your balances, all of that stuff, right? If you can pay down your balance or pay it off before the end of the billing cycle date, then what you're going to do is you're going to be able to get that balance down, reflect great payment history, and get that imprint into your account before it's reported out to the agencies. And by doing so, hopefully you have lower utilization and then a much improved credit score. Last component is pretty self-explanatory. It's the payment history, right? So it's how we paid our bills. If we're looking at late payments in particular, it's taking a really big snapshot of the last 12 to 24 months. The more severe my delinquencies are, the bigger impact I'm going to have to my credit score. Delinquencies are rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more severe my credit late is going to be, the bigger impact I'm going to have to my credit score. All right, we're going to talk a little bit about student loans for a few minutes. Before I do that, and I'm kind of just monitoring what's in the chat, any questions so far on our topics we've discussed so far in class? And again, you can just put your questions either in the chat or in Q&A, and we'll get those answered. I got both of those up right now, so feel free to drop those in, and I'll make sure we get those answered on air. All right, so we'll keep it moving here. Let's talk a little bit about student loans. And if you do have federal student loan debt, it is in forbearance right now based upon some of the litigation right now as it relates to forgiveness of student loan debt. And at this very moment in time, I think there's not going to be any ruling on that until September, October. So it does pose a little bit of an issue when it comes to qualifying on a mortgage. Now, if you're currently in an income-based repayment plan and your student loan servicer is reporting that plan to the credit bureaus, then we can use those payments for qualifying purposes. But some student loan servicing companies are actually reporting zero. And in that case, we may not be able to use the income-based repayment amount for qualifying because that loan is in forbearance and we have to properly document that you're in active repayment status in order to use the IBR plan. Now that'll change hopefully after September, October, once there's a ruling, but that's where that stands right now. Now, by default, though, if we're in forbearance and we can't properly document an income-based repayment amount, then we look at 0.5% of the balances for an FHA loan, 1% of the balances for a conventional loan, which would be a Fannie Mae or Freddie Mac loan. So there are workaround options, but I think a lot of our clients, especially that have IBR payments right now, unless it's reporting to the credit bureaus, it can be a little bit challenging. And some clients do have zero payments because that's what their IBR payment was according to their income qualifying, and that's completely allowed as long as the credit bureaus are reporting that properly. Even if you're in a deferment status because maybe you're back in school working on your master's program or whatever the case may be, we still would have to count a minimum payment for qualifying. Okay, I saw a question in the chat on mortgage insurance. We actually have a separate kind of a conversation or page on mortgage insurance. We're going to do a lesson around that. So we'll get to that question in just a little bit. But mortgage insurance essentially is going to be something that comes into play for less than 20% down payments. But we'll dive into that in great detail for you. All right, let's talk a little bit about loan programs. And actually, before I do that, I just had a question that popped in on the IBR program because I think that I want to make sure I'm getting the right information to you on student loans. And the question was, if I have an IBR plan, but my husband's currently a student and has an in-school deferment, how would that look for us? So as kind of a default, if the IBR plan shows up on your credit report as in terms of the payments, then we can use those payments for qualifying. For your husband, if your husband's in deferment, then ultimately there's no payments required. So by default, because of that deferment, then we would have to use 0.5% for the FHA loan if we're qualifying for that particular product, or 1% of the balances if we're qualifying for a conventional loan. Okay, and we can kind of take that offline too if you want to kind of talk one-on-one on that. We can figure out kind of what the optimal way is to build that financing, depending on maybe what your husband's source of income is. So we'll have to kind of see what the best way is to structure financing. All right, let's talk a little bit about loan programs. And so we've kind of spotlighted 5 of the core programs that are the most popular for us in providing financing solutions across the country in our local communities. So let's talk a little bit about, from a high level perspective, each one of these programs. One is the conventional product. You've heard me talk a little bit about Fannie Mae and Freddie Mac this evening, but conventional loans occupy about 60 to 70% of the origination space across the country. A conventional loan has a minimum down payment of 3%. A lot of clients think that to do a conventional loan, I have to do a 20% down payment, which is definitely not the case. So as a first-time buyer, it's a minimum down payment of 3%, minimum credit score of 620. Now, across the country, there's different loan limits for these type of products. Now, there's a set conforming loan limit, which is 802, 650. In the Sacramento area, you can go up slightly higher. I think it's like 806. Anytime we go beyond 802, 650, it now enters a space called high balance, which basically elevates the amount of down payment. So it goes from 3% down payment to 5% down payment. If we're in higher cost of living markets, like let's say you're joining us today from Santa Clara County, we can go up to a loan amount of 1.2 million essentially in that market, but it does require the elevated down payment of 5%. The next product is the FHA home loan, which is the Federal Housing Administration loan, is a government-backed or government-insured loan. Minimum down payment of 3.5% of the sales price. Credit score minimum goes down lower to 580. Loan amounts for the FHA loan vary based upon where I'm going to purchase in the country. Right here in the Sacramento market, we're at $763,600 as the maximum loan amount. Usually when we look at the majority of our products that we're offering locally, it's going to be centered around the conventional or FHA loan, especially for our first-time buyers. Now, we're going to do a comparison of conventional versus FHA as it relates to mortgage insurance. I know one of our guests had some specific questions around that, so we're gonna dive into that in just a bit. And then the next product is the jumbo loan product. Not going to be one of our typical products for most first-time buyers, but ultimately that is a funding resource for clients that need ultimately more lending options outside of the conventional space. So if we exceed those conforming or high balance limits, we would look at a jumbo loan, but it does carry with it higher down payment requirements, 10 to 15%, higher FICO score requirements of 700 plus. So jumbo loans aren't necessarily going to be something that most first-time buyers are going to tackle in their first purchase, but certainly can be an option. The VA home loan is for our veterans that have eligibility. With the VA home loan, it's a 0 down payment option to help make down payments easier for the veteran. Minimum credit score of 620. The VA product has a lot more flexibility for the veteran, especially from a expense to income ratio. We call that debt to income ratio that we're going to talk about later tonight. But the VA home loan product is an incredible resource for our veterans. There really is no loan amount on the VA product, but it does have that 0 down payment option, which is obviously a big deal. The USDA product is for clients that want to buy in more rural markets. So when we think about that, we're looking at maybe say Placerville, or we're looking at maybe in Williams. Those areas would be considered USDA eligible. The benefit around this product, it's a zero down payment option. It does have two major qualifiers. One is we have to hit a certain income limit by household size, and then we also have geographical limitations as well. So it has to be a USDA designated rural area. While the product has a zero down payment option, it can be a little bit more restrictive in terms of expenses versus income. And so, there is certainly an opportunity for clients with that product, but it may be a little bit more restrictive than, say, looking at a conventional or FHA product. As we kind of move through our class, I just want to kind of just acknowledge a couple questions that are in the chat, which is around the CalHFA programs. We are going to talk specifically about CalHFA, which is the first-time homebuyer assistance programs. So we have a complete segment for that. And then another question was, is there a way to check eligibility for the VA home loan if I'm currently in the Army Guard? Yeah, so you can go to the VA site. We can get you, you basically need to check the certificate of eligibility, or we call it COE. You can check to see what your eligibility benefits look like. We can follow up with you for a link for that to the VA site if you like after tonight's class. All right. Great questions. We appreciate the interactions in our chat. So that's great, guys. Let's talk a little bit about PMI. I know that came out as one of our questions for tonight. And so we're going to dive in a little deeper and look closer at PMI. I want to do it as a comparison to conventional versus FHA loans. When you think about PMI, PMI is essentially insuring the lender against default or some default situation by the buyer. Now there's two forms of PMI. There's private mortgage insurance, which essentially are private companies that are insuring the lender, but there's also MIP, which is essentially the government insurance component of an FHA loan. So let's kind of look at both right now. On the conventional side of it, PMI will come into play when I put less than 20% down to purchase my home. Now, PMI is tiered in different premium levels based upon my down payment, what my amount finance looks like, and then what my credit score is. So there's different tiers. So usually it goes in tiers of 15 to 20% down, then we have 10 to 15%, and then we have 5 to 10% down, and then we have 3% down. And so as we put less money down, as maybe we have lower credit scores, then we might see a more elevated cost to our PMI. Now, with conventional PMI, it does have a cancellation option in most scenarios where once I have 2 years in my loan and I have 22% equity, I can apply to have my mortgage insurance canceled. Okay, so that's one of the big advantages of a conventional PMI option. But there is a big myth out there that most clients think to go with a conventional product, I have to have 20% down, which essentially is definitely not the case, as you're learning tonight. If we looked at the scenario of, let's say, a $450,000 loan amount, and I'm putting 3% down and my credit score is 740, I'm probably looking at a PMI estimate of about $183 a month. Okay, so that's what I would see. Now, some of you in tonight's class may have already started your searches for your homes on Redfin or Zillow, and totally great. But their calculators, what I've found, can be a little bit more inflated when it comes to the cost of mortgage insurance. And so as you meet with us for a consultation and I kind of figure out the design of your home financing, we're going to figure out the right PMI level for you, but there certainly is not as high as you might see on some of the sites that you might be visiting. Now, if we look at the FHA side of things, a little bit different from a mortgage insurance perspective. One is there's two forms of mortgage insurance. There's monthly mortgage insurance, and then there's upfront mortgage insurance. Monthly mortgage insurance is calculated at 0.55% of my loan amount. And then we divide that by 12. That's how much we come up with the dollar, or that's how we come up with the dollar figure. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. And then that gets baked into my total amount financed. So cost will change a little bit on the FHA side. It also does not have a cancellation option. So really my only way of exiting mortgage insurance on an FHA loan is to essentially refinance my home at some point into a conventional loan product. Now, when we look at the FHA product design, for most of our clients, it's going to be kind of a temporary solution in my mind, where we're using the FHA loan for the next 2, maybe 3 years to help improve a particular scenario. Maybe it's expenses or maybe my credit score, to help at one point to be able to move into more of a conventional product. So FHA can be a great entry point because of the leniency or flexibility within the guidelines, but maybe not the forever loan for our clients. When we look at the payment options on mortgage insurance and we take that same $450,000 loan scenario, we're looking at upfront mortgage insurance of $12,250. It gets added into my balance. And then the monthly amount is at $206.25, which is at 0.55% of the total loan amount. So clearly a little bit of a difference in comparison conventional versus FHA when we look at the expense structure on a monthly and upfront basis. But I do think it's important to understand each product is going to have different guidelines and not all clients will qualify in a conventional loan. So FHA can be a really great entry point for clients that are trying to obtain homeownership and provide that resource that's needed. Both of these products can be coupled with first-time buyer programs. In fact, the VA and USDA product can also be coupled with first-time buyer products. We're going to talk more about that in just a bit during our CalHFA section of tonight's class. I want to make sure I acknowledge a couple of questions here in the chat. Let me just make sure. So one question was, the higher my credit score is it the higher that I'm going to be approved for a loan? Not necessarily the case. So credit is one component, but income is going to be another component. Savings will be another. In fact, that's going to be a great lead into what we're going to talk about next is income. Credit is going to dictate eligible product. It's going to dictate interest rate and potentially mortgage insurance costs. All right. And then another question was, what if I cleared up all my credit card debts in one sitting? Does that have a negative impact in my credit score? And is the timeline when these debts to be cleared at time of pre-approval, or should I wait a few months? So a couple things. By clearing credit card debt, not a bad thing. So thumbs up on that. In terms of the timeline of doing that, it really depends on how quickly you want to have that incorporated into your pre-approval. One of the nice things about our pre-approval process is we can customize things with what-if scenarios. So we can meet together for a one-on-one and analyze your debt and say, okay, if we pay off this, this, and this, then that'll help bring down our utilization, help improve our credit score, and build what-if pre-approval scenarios based upon that. So I always encourage clients to get connected with us sooner than later, because I do think paying off debt, there is some strategy to that. And I don't want clients to feel like they have to go out and be picture perfect before they meet with us. We can design a plan that's going to help them on that path towards homeownership so they don't have to wait, but we can get together sooner than later to set some goals and objectives for homeownership. All right. Okay, cool. I think we're up to speed on chat questions. Let's talk about income. I think we had one of those questions, like I said, about does credit just one of the major factors for qualifying? It's not necessarily the only thing. We are going to look at income. And there is a way that we have to validate income, whether that's through W-2s, tax returns for the last couple of years. We'll look at bank statements on the asset side, and then back to income, we'll look at the last 60 days of pay stubs. And then I think it's important to understand how we view income, because there's a lot of misinformation out there. As a lender, we do have to validate 2 years of work or educational history. And here's what I mean by that. If I'm looking at a scenario where I just graduated from Sac State in the fall, I just started my job January 1, I can still potentially qualify for a home mortgage, because if I graduated with an accounting degree from Sac State, I was at Sac State for 4 years, even though I just started my job, because I have that 2 years requirement met of my education and employment, which will be my income source, that would help me to qualify for a home mortgage. So it's really us verifying 2 years of history. I could even be switching jobs. Let's say maybe I started for a private company and I've been working there for 6 months, but then I got a new job with the state of California. I can still use the state of California income for qualifying, even though it's going to be maybe a recent job for me, or maybe I've been on that job less than 2 years, whatever the scenario might be. So I think that's important as a potential buyer, knowing that there are solutions out there, so you don't have to have a certain waiting period, if you will. Now, where it might be a little bit more challenging is if you're in a position that has variable income, like let's say you get overtime with your job or commissions or bonus, whatever the case may be. In that scenario, I do have to demonstrate 2 years with that employer, because those variable sources have to be verified or averaged over a 2-year span of time. The 2-year rule also is important in multiple jobs. So if I have someone that's working full-time with one position and then maybe also working part-time, I have to verify that I've been on both jobs simultaneously for 2 years. Sometimes we see that in the healthcare industry, where I have a client that maybe works at one clinic for 30 hours a week, maybe 20 hours at another. I do have to demonstrate 2 years simultaneous work history in that scenario. If I'm self-employed, like I'm 1099, maybe I drive for Uber or Lyft, I do have to show 2 years of tax filings in order to use self-employment income. Even if I'm working full-time and maybe driving for Lyft on the side, I do have to show 2 years of simultaneous employment. So if I'm looking to use dual sources, that's where that 2-year requirement can be a little bit more challenging. Now, we're going to walk through those things with you during a consultation. We're going to talk about what income we can validate and maybe time on the job, and just to make sure that there's no concerns around building your financing with income. But hopefully that kind of dispels some of the myths out there in the marketplace around employment. So question in the chat was, if you have an offer letter, I'm kind of picking up where this question left off, but there was a question around, does the offer letter count if we switch jobs? So yeah, so if let's say I'm working at a job right now, let's say I've been there for 2 years, and then I know I'm going to be switching jobs and I have an offer letter to start my new job, I can use that new offer letter because I'm going to start, let's say, April 1 or March 1st. I can use that offer letter to help myself qualify for my new home financing. Okay, great question. All right. Sticking with the theme of income, now I want to do a quick comparison and looking at income versus expenses. And we call that debt to income ratio. We're essentially looking at your pre-tax income, or if you're self-employed, your net income. And we're comparing that versus your outgoing existing expenses, as well as what your new housing budget is going to look like. So when we look at that calculation, you can see that off screen here, but I want to kind of explain to you what goes into that. So we have our housing budget, which includes principal and interest of the loan, the property taxes of my house, what my homeowner's insurance will be, and then mortgage insurance, of course, if I'm putting less than 20% down, or I'm maybe doing an FHA loan. And then if I'm purchasing a townhouse, maybe a condo, homeowners association expenses. So we plug that into our calculation. Then we also look at our other debts that appear on the credit report, like credit card debt, personal loans. We're looking at student loans, maybe any type of auto financing that's out there. So that gets factored into our expenses. And so if you look at our example here, we have someone that has $3,000 expenses. They're making $8,500 a month. So their debt to income ratio is 35.3%. Now, the guidelines for most loan programs allow us to go to 45, even as high as 50% of our pre-tax income being occupied by expenses. And you can see kind of our kind of different levels that we're looking at. I would say, most of our clients, when we think about where their comfort zone is from a debt to income ratio perspective, it's usually around 33 to 36%. I would consider that to be in the comfort zone. Some clients may be okay going at higher levels, 45, even 50%. But in most of those scenarios, we're seeing other sources of income that are helping supplement the household expenses that maybe aren't necessarily part of the application or being included. Because in this scenario, when we're looking and evaluating income, we can only consider applicant income, not necessarily outside income contributors to the household. But ultimately, I think, we really want to maintain those expenses at 33 to 36%. At the end of the day, debt to income ratio is going to be a metric to help us determine qualifying. Doesn't give us an indication of affordability. That's a conversation that you and I are going to have as part of your consultation, just to figure out what does affordability look like. Affordability might be a $2,500 mortgage payment, even though your debt to income ratio says you can go to a $4,000 mortgage payment. So those are conversations that we'll have in building a comprehensive plan for you. So the last stop in figuring out what homeownership looks like for us is kind of really around the down payment and savings for homeownership. I mentioned it earlier in our class. There's kind of two challenges to homeownership. It could be credit, but it also could be just lack of resources for down payment. And so let's kind of talk a little bit about what's needed and how we document down payment. Well, checking and savings accounts can certainly be used. Cash deposits cannot be used because we generally have to paper trail 60 days worth of asset activity. Now, retirement accounts can potentially be used, 401ks, even 403bs, brokerage accounts, as long as we can see that those funds have been there for 60 days. Sometimes family members will help out with home buying, and that's completely allowed. Those assets do not have any type of seasoning requirement. Those are called gift funds, where a family member has helped you. There's a kind of a documentation process for that, where the donor completes a gift letter, and then we kind of show the paper trail of funds. Now, savings is a challenge, and we understand in today's market where affordability is a challenge, and high cost of living, like we've kind of talked a little bit about earlier, with the cost of housing at all-time highs. So we understand that savings can be a challenge, but one of the things we like to help in our classes is to kind of provide a savings plan for you. So as I meet with clients and to figure out what their path towards homeownership looks like, we do this savings plan exercise, which essentially is to look at what am I paying today. So in this scenario, you can see on screen, we have someone's paying $2,000 a month, but what can I think I can pay as a homeowner? Because you're more than likely going to have to increase that outgoing budget to maybe potentially purchase. And so if we have someone that feels comfortable going to a $3,500 housing budget, right now we can see there's about a $1,500 gap, right? So if we're challenged with savings, what I would tell a client to do is let's start saving like we're paying a mortgage payment today. So when I send my landlord my monthly rent of $2,000 a month, what I do at the same time is I'm taking $1,500 in contribution to my savings account. And what that's doing is doing two kind of really incredible things. It's doing one is it's creating the rhythm or discipline of saving that much money, but also getting the understanding of like what that's going to do to my budget of paying $3,500 a month. And so I can create that discipline for myself. And then at the same time, I'm growing $1,500 on a monthly basis. So by the end of 6 months, I have $9,000 in my savings account. By the end of the year, I got $18,000, not including interest and high yield accounts. So I think that's a great way to kind of get started in saving for home ownership, because again, that is probably one of our bigger challenges next to credit when it comes to designing plans for clients. All right. Okay. So there's a STIRS question in the chat. We might need to take that offline, but we'll kind of maybe hit on that in just a bit after we kind of go over CalHFA. But CalSTIRS, I don't believe has an online product right now, but certainly CalSTIRS is part of your retirement plan as a teacher. We can probably talk about that one offline, and we can kind of talk through some different scenarios. I do want to kind of transition into the CalHFA first-time homebuyer program options. We had some requests for that earlier today. So we are the leading provider of CalHFA in the state of California. We're really pleased to have that designation. I'm really passionate about serving in first-time homebuyership in our communities. You may have heard about CalHFA through the broadcast of different programs like the Dream for All product, which successfully launched the last 2 years. If you're interested in Dream for All, unfortunately, that product is not available at the current moment. The difference with Dream for All is that's a state general funded product. Currently, we do not have any funding for Dream for All. That may see something in the future, but at this point, Dream for All is not active. Those that received vouchers for the Dream for All now are actively shopping. And certainly, now that you've attended one of our classes, we'll keep you up to date on any future developments with that product. But today, CalHFA has a whole suite of products. And in fact, we're going to be announcing another product on March 17th that can help provide resources for you in homeownership. And so let's look at some of these products. One is the MyHome Assistance Program. The MyHome Assistance Program will provide a first-time buyer up to 3% of your sales price in assistance on a conventional loan. For an FHA loan, it's 3.5% of the sales price in assistance. Essentially what it is, it's a separate loan that we create for you through CalHFA at a 1% simple interest rate loan. And those monies are not paid back until you either sell the home or if you decide to refinance in the future. Okay, so if you look at that contribution of 3% or 3.5%, it's basically the minimum amounts for the conventional loan or FHA loan. Now, we can also add in closing cost assistance programs as well. On March 17th, we're going to announce, or we've already announced, but we're going to launch another product with CalHFA called the MyAccess product, which you can add on in addition to the MyHome Assistance Program. It's a bond program that essentially will provide up to 2.5% of the loan amount in additional assistance. That is another 1% simple interest deferred payment that you can utilize to help reduce down those out-of-pocket expenses. Currently, we do have the ZIP Assistance Program active, but the ZIP Assistance Program can elevate the cost of the first mortgage rate. So our hope is that the MyAccess product will provide maybe some cheaper funding resources for our clients utilizing the CalHFA product that need some additional funding. To jump back to the CalHFA conventional product, one of the really big benefits of the CalHFA first-time homebuyer program is when we think about interest rates for a standard conventional loan, as I mentioned earlier, it's based upon the interest rate's based upon credit score, down payment, and how much you finance. With a CalHFA conventional loan, it's a one size fits all interest rate. So like today's interest rates for the CalHFA conventional loan is 6.875% for 3% down or even 20% down. If you compare that to a 3% down conventional loan, without first-time buyer assistance, it could be as much as 0.5% higher for a buyer. So that's a really big benefit in getting essentially in a cheaper interest rate option with the CalHFA product line. Now, there are other products available outside of CalHFA that we offer. The Pathway DPA program allows clients that maybe does not necessarily qualify in the CalHFA suite to be able to still get some access to resources. The GSFA program, also known as the Golden State Finance Authority product, can also be another tool for us. That would be a product that we would look at as an alternative to CalHFA if maybe one of our clients did not qualify in CalHFA. And then Fannie Mae and Freddie Mac also offer some affordable housing products that are available all across the country. Of course, the CalHFA suite of products are available just in the state of California. I did see some questions in the chat around specific teachers programs. So there isn't specific teacher programs available. The GSFA product will do some discounted options for county employees, and I believe for teachers as well. At times I hear from clients the Teachers Next Door program. You do see that out there, but that's not an affiliation of an assistance program. It's a lender that has created a site that will provide some minimal assistance. What I found is, especially for teachers, using a CalHFA system assistance program is going to provide far more resources for a buyer. Now, there are local community programs like the SHRA program, the Sacramento Housing and Redevelopment Agency. Those programs will be a little bit more restricted from an income perspective, but there's certainly resources available for our low-income housing buyers. The CalHFA product line is going to support low to moderate income housing buyers. That's a big difference because low-income housing is considered less than 80% of the median income, which is essentially below $91,000 in the Sacramento market. 150% or moderate income goes up to $225,000 in income. So that's a big variance. I want to share with you just a quick example of how CalHFA can benefit you. So if you were to look at, let's say, a $450,000 home like we did during our budgeting exercise, we have a 3% down payment of $13,500, and then we have closing costs set into the calculation. I would probably need to save about $22,500 to maybe $27,000 in resources, right? That might be a bit of a stretch for most of our first-time buyers, and it may create, home ownership 3, 4, 5 years from now. However, if we were to substitute in CalHFA, now I have that MyHome assistance program that can help supplement for my need for down payment, and perhaps use the MyAccess program or maybe even the ZIP program to help augment what I need for closing costs support as well too. So maybe that eligible assistance rises to $24,750, and then I don't have as big of a coverage point when it comes to what I need for my home purchase. And so those are things that we're going to help you through in customizing a plan for you, and see different assistance programs like CalHFA that can really help benefit you. The CalHFA product does have minimum credit score requirements. So it's 640 for the FHA loan, 680 for a conventional loan. Now, if I'm a low income housing buyer that makes less than 80% of the median income, 660 is the minimum credit score. The debt to income ratio that we talked about earlier goes anywhere between 45 to 50%. With this program, the income is only based upon the applicant, not necessarily a household size like we'll see in most first-time buyer programs. And a first-time buyer is someone to be eligible for this program, you have to be a first-time buyer, but it's actually someone that hasn't owned a home in the last 3 years. So I may have sold my home back in 2010 and been renting ever since. Well, guess what? I'm still a first-time buyer in the eyes of this product. So it's eligible for any one unit property. So single family homes, condos, townhouses, even manufactured homes. But with manufactured homes, it cannot be like in a park, like a mobile home park. It has to be actually on land that we own. I kind of shared a glimpse of what the income limits are here in Sacramento County. You can see those on screen at $225 for Sacramento, and then we kind of put in some of our surrounding counties here. You may be joining us from the Bay Area markets or some of the Southern California markets. We can share with you the CalHFA income limits for any of those areas as well if you're interested in purchasing any of those markets. All right. I know I gave you a lot of information. I know we're getting up to the top of the hour, but I encourage you to kind of stick around because I do want to kind of share with you the buying process, which I think is a really important next step for you in this class. But I want to just make sure, and by the way, Ken just put in the income limits for the program for across the state in the chat. So if you want to check that out. Any questions on CalHFA before I move into the buying process? I want to make sure I also respect your time this evening. Okay. All right. Let's go ahead and go through the buying process. Again, I think this is a really important piece to understand on where do we go from here. So clearly you've taken some time out of your busy Wednesday nights to learn about home buying. So let's talk a little bit about next steps. So after tonight's class, we would encourage you to get connected with us for a consultation. That's a one-on-one I do with every client that works with our team, and I help them design a home buying plan for them. It's basically about a 30-minute session that we dive in and create a strategic plan for home ownership. Now, after we conclude that meeting, we generate what we call as a pre-approval, which essentially a pre-approval is a document that allows you to go out and begin your home shopping. And you can present that pre-approval with an offer to a seller to show that your financing has been all validated, that a lender like us has validated your credit, your income, your assets, maybe set up a first-time buyer program for you. So that's all completely set up as part of that pre-approval consultation. Now, the pre-approval is good for 60 days, but we can always recertify that at any time. I know we've had a couple questions tonight about when should I start the pre-approval process? We encourage you to start sooner than later because I think if you can have a plan in mind, then you'll kind of know what the goals and objectives look like. So whether you're buying this year or you're going to buy next year, right? You can at least kind of know what the different markers are for you in achieving homeownership. Step 2 is going to be house hunting. That's where we're going to actually start exploring online different options. I would encourage you to partner with a realtor. A realtor should be an expert in their local communities on what's going on with different statistics of the market, but they're also experts in negotiating and have business partners that can help you with inspections. All those things are going to be really important in a trusted realtor source. We do have a preferred network of realtors locally and abroad that can help you in that home search process, but that's a really important component of step 2. It's usually going to start online, and then it'll kind of move to in-person viewings of homes, going out to open houses or whatever. Now let's fast forward a little bit. Let's say I find that home that I love and I make an offer, and guess what? The offer is accepted. Well, that's a huge celebration because honestly, that's half the battle of homeownership is finding the right house for yourselves. But if we find that home, that's going to create day 1 of what we call as entering escrow. Usually most real estate transactions are 30 days. So from the time at which my offer gets accepted to the time I get my keys, it takes about 30 days. Now that process can be condensed into shorter periods of time. We actually have an express or quick close program that can condense that to 14 days, which is super fast. But traditionally it's at a 30-day timeline. Now, what happens at step 3? Well, the seller's accepted our offer. It's day 1 of the escrow process. You're going to get a call from me within 24 hours of that accepted offer and say, congratulations. Let's talk a little bit about next steps. Let's schedule you for your follow-up consultation so we can figure out what this plan looks like for us now. And during that consultation, we're going to review, what's the financing look like? What are today's interest rates? What's our payment goal again? Let's talk about what our out-of-pocket expense looks like based upon your agreement with the seller. Now, you're also going to have action items as a buyer, which includes making an earnest money deposit for your home purchase. Usually that's 1% to 2% of your sales price, but that will count towards your out-of-pocket expense for your home buying. Now, in most contracts in California, you'll have a contingency period for that purchase. And the contingency period allows you to do your homework on the property to make sure everything kind of checks all the boxes for you. That includes getting an appraisal done of the property to ensure the house is worth what you're buying it for. Get your inspections done to make sure there's no issues with the home, whether it's sewer issues, roof issues, plumbing, whatever the case may be. And then also get your loan approved with your lender. Those activities will usually take place in the first 17 days of your contract. And why it's really important is because if something goes awry with one of those inspection reports or maybe the appraisal, you have that protection to be able to exit that contract and not risk losing your deposit. Now, if we were to go further down the process, we look at step 4. That's more the administrative functions of the financing. We're going to be verifying employment. We're verifying assets. Throughout the process, we're going to be talking a little bit about the interest rate environment because Just because we have an accepted contract on day one doesn't necessarily mean we have to lock in the interest rate that day. There's some strategy based upon reviewing economic conditions on locking in that interest rate. I would consider us experts on kind of managing through the market, but there is some strategy to that. Locking in an interest rate essentially means securing that interest rate. So while I'm in that escrow time period, any volatility in the markets won't impact my rate as well as my overall monthly payment. Step 5 gets us almost 3/4 of the way through the process. And by that time, we have our loan approval back. We probably have our inspections, our appraisal, and we're starting to kind of move to what we call the closing process. Before we get there, though, as a buyer, you have the opportunity to make sure that everything has been accounted for on your appraisal, on your loan approval, and your inspections. And then you can sign off on your contingency, which essentially tells the seller that you're ready to move to the final stages. And as a lender, we're going to issue to you a final closing disclosure, which essentially gives you a 3-day cooling off period before you get to the final stage of step 6. Now, that closing disclosure is an e-signature document. Throughout the process, you're going to be getting a disclosure sent to you via e-signature. Within 72 hours of contract, you get a disclosure. Once we lock in your interest rate, you also get another disclosure. Now, most of this stuff can be done electronically. However, at step 6, you do have to do what we call an in-person signing to sign your final loan documents with a public notary. That process with that notary takes about an hour or so, depending on the type of product you're looking at. In that session, you're going to review all your final loan documents. Once that's concluded, then you'll be wiring in your final funds for your home purchase. Those monies get reconciled by an escrow team. We also wire in the funds for your loan financing. And once those monies are accounted for, then documents get recorded with the local county recorder's office, like the Sacramento County Recorder's Office, which is just a block away from our office here. And those documents get recorded to transfer ownership to you, which is the grant deed, and then the deed for the loan. And once all those things get confirmed as recorded, then we get to call you with our favorite news of the day, which is to say, guess what? You're now a homeowner. I made a few of those calls this morning. Great way to start the day. But ultimately, the process has been concluded, and now you own your home. Huge celebration for us and our team because you did it. And you know what's cool about it is it usually starts in classes like this. In fact, just this week, we had one of our fellow Sac State alum buy their home here locally in Sacramento and attended a class just like you're sitting in right now. So it can certainly happen. And so that's why I love to share with you kind of what that path looks like to homeownership, to go from classroom setting to getting pre-approved to getting the keys to your home. Now, after we close escrow with our clients, the relationship doesn't stop there. So we have what we call our aftercare program. We have a rate watch system to watch for rates to hit a certain level to help a client refinance and save money over time. We also have a HomeBot system that helps kind of show them what their market value is going of their home. And again, refinance opportunities. And we always do annual check-ins with our clients and always staying connected, because this isn't a transactional relationship for us. It's a long-term relationship, because I can't tell you how many clients have bought homes with us and then found their next home for their family as they're growing. And so we want to be there as financial things are changing for you in your lives over time. Now, as we're getting wrapped up in class, I know we're over time here, and this is our special Sacramento class. So I appreciate everyone kind of hanging out with us. If you're thinking about now going from tonight's class and getting connected with me for a consultation, I'd love to be able to get a chance to meet with you. We have a really simple get started process. It starts with an online application. We only do a soft credit check, so you don't have to worry about your score being impacted. And then you'll upload proof of your income and assets. And then you use our scheduling system, which is kind of highlighted here, to book a 30-minute one-on-one video consultation with me to design your own home buying plan. So you don't have to be ready to go buy a house this weekend. It could be next year or even later this year, but we want to just give you some tools and resources. It's a free service we provide, so we just want to make sure you have all the right tools. Now, if you have some specific questions for your own financial situation and want to just kind of get connected with us to go through some different scenarios, we have an introductory call option that you can also access through our scheduling system. We'd love to be able to have that conversation with you. And just to kind of reiterate what happens during that free consultation, we're going to talk about, where do I want to buy? What's my budget look like? What are some credit opportunities for myself? Can I really benefit from an assistance program? And then we'll kind of walk you through the buying process. And hopefully by the conclusion of that session, we have you designed for a pre-approval and have you on your path towards homeownership. As I wrap up now, I just want to point out one of our mobile resources that you can actually start the application process right there. It's our APM mobile app. You can do an online application there. You can follow the progress of your loan as you're going down the different milestones in the process. And what a lot of buyers find it helpful to do is actually do payment calculations. So if you're out looking at a home or an open house, you can run some different payment scenarios and see if that's within your budget. All right, well, we're at the end of tonight's class. I want to again kind of spotlight our benefit with Sac State alumni, as well as our state of California employees. We discount our services by $750 in kind of our partner discount program. We also have other partnerships in California, but across the country that we do very similar workshops like this. So if you have friends, family, maybe some coworkers that would benefit from a class like this, feel free to check out our upcoming workshops at mortgageeducate.com. Again, we probably have 50 more classes left for 2025, and we'd love to have those attend that are interested. All right. Well, I know I'm 9 minutes over the hour, but hopefully this is worth sticking around. We still have a pretty good sized group there. I want to make sure that I'm not missing any questions. So I know Ken's feverishly typing away there, helping me out. Let me take one of these questions here. And the question is, assuming if a qualified candidate signs up for some of these loan programs, are you under any contract to stay in the loan for a specified time, or are you able to refi at any time? So the CalHFA programs that we looked at today, you can refinance at any time. So there's no restrictions around that. Of course, to my point earlier, we want to make sure the refinance benefits you. And so we wouldn't want to, if we bought a home today at 6.875% rate, we wouldn't want to refinance at 6.5%. We want to make sure there's a clear net tangible benefit for you. All right, thanks for the question. I'm going to kind of scroll back. I think one question I had, I think Ken was able to type out for our audience member, which is, can I be on Social Security and still qualify for a home loan? And that's absolutely the case. So Social Security income, IHSS income is all allowable income for financing. So yeah, absolutely. Okay, thanks for that. And no, question in chat was, is there any type of proof that we need to provide that we've attended tonight's presentation? No, you signed up for tonight's class, and there's nothing other than, we'd love to be able to get connected with you for that next step. But yeah, for sure. And here's all my contact information. So you can, get a chance to either just message me with any questions you have. You can book that introductory call with us if you have follow-up questions after tonight's class, or hopefully we're getting a chance to get connected for our consultation. And last thing I just want to point out to our audience, we love what our clients say about us, especially in our local Sacramento community where most of you guys are attending from tonight. We really take pride in what we do for our local communities and homeownership. And so we'd encourage you to check out what people are saying this in our over 200 Google reviews, and what we kind of really share with on our social platforms like YouTube and Instagram. It's not just testimonials, but it's also good resources for you as first-time home buyers. All right. Well, with that said, we're at the end of class. Thank you so much for being patient with us this evening, for all of us. And we hopefully get a chance to get connected with you at some point, and look forward to helping you on this journey towards home ownership. Have a wonderful evening. Look forward to seeing you soon. Good night.